5 mistakes that I made when I first started investing. In this video, I'm going to be running through 5 mistakes that I personally made myself when I first started investing around 3 years ago is when I actually properly started to invest myself, and I made a number of mistakes. A lot of them are very simple, very common, very avoidable, and happened right at the start pretty much. I'm going to be running through each one, giving you a bit of background. It's going to be a relatively short video, but hopefully if you're yet to start investing yet, or you're still a fairly new investor, these are just some mistakes you can avoid. Essentially save yourself some money, save yourself some time, and obviously make the best investments possible for your personal situation. My name is Ryan, welcome back to another video here on Making Money Simple. Hopefully weekly videos going forward now, so feel free to subscribe if you have a second so you don't miss any future videos. I'm also on loads of other social media platforms, so of course you need to follow me on all of them. I've also got some products available, all the links will be in the description. But this video here is going to be about 5 investing mistakes that I personally made when it comes to investing. 4 of them were pretty much right at the start within my first month or 2 of actually being an investor. And then the 5th one was more of a continuing mistake that I used to make and I no longer do. So the first one is buying based off of a tip. Now I feel like this is quite a common thing when it comes to like football, horse racing, that sort of stuff. People are always dishing out tips and sharing their tips around, and people occasionally will put a bet on based on someone's tip. And the same thing really goes with the stock market. Of course, a lot of people make YouTube videos and content on specific stocks. And in my case, I watched a 10-minute YouTube video, this was in August 2018, about a stock, and I essentially invested based off of that tip. Invested my own hard-earned money based on a 10-minute YouTube video.
Are you stupid or something?
This is a mistake you want to avoid. Every investment you make, you want to have a reason for it, and you want to understand why you're actually making that investment. What is the point in that investment? I essentially made a random investment based off of a tip I saw on YouTube. Luckily, it was only a few £100, but it's still money I worked hard to earn. And yeah, ultimately, do not invest based on tips. Is an easy mistake to make, and one that a lot of people fall prey to. Of course, there's nothing wrong with watching, YouTube videos recommending stocks or analysing a stock, but make sure that actual stock or that investment makes sense for you and you understand what the company does, what you're getting into, and so on. And the same thing applies to funds. People will recommend funds. Of course, I talk about the funds that I personally invest into, but once again, you need to do your own research and make sure the fund or the stock makes sense for your situation. Number 2, now this links into number 1, and I bought this stock with high commission, a very high fee I paid to buy this stock. At the time, it cost me £12.50, mistake number 1, and I paid an FX fee.
That's a lot of damage.
Well, I think I used Halifax share dealing at the time. We're gonna get onto another mistake relating to that soon. I used Halifax share dealing, and I paid both the commission of £12.50 to make the trade and also the FX fee. When I then had to sell the stock, obviously a couple of years afterwards, I then once again had to pay another trade commission.
That's a lot of damage.
So essentially, all of those fees pretty much eradicated my gain. I think in the end I made a small percent gain, but had I not paid all of them fees, had I used a lower fee platform, then I would have got probably a double-digit gain. So number 2, the mistake to avoid is buying with high commission, buying with high trading fees, and there's really no excuse for this nowadays. We have 0 commission brokers like Trading 212, Free Trade, Stake. We have Vanguard, who I use my stocks and shares ISA, who are very low fee. There's really no reason to be paying high fees or high commissions when it comes to investing in the stock market. But of course, when I started, I wasn't aware of those platforms that I listed. I thought you had to open an investment account with the company you banked with, which is why I went with Halifax share dealing, paid high fees, and of course, luckily, I learned that mistake early, and I haven't made it again since.
But wait, there's more.
Number 3, which links once again to number 1 and 2, you can see how literally on my first investment I made loads of mistakes. Not only did I buy based on the tip, buy with high commission, but number 3, I made this investment within a general investment account and not a stocks and shares ISA. To explain the difference quickly, with a stocks and shares ISA, all the money we invest grows tax-free and all of the dividends are tax-free, whereas a general investment account has no tax advantages. Now, of course, we do get like a capital gains tax allowance, currently £12,300. I was nowhere near that, so of course I didn't have to pay any tax anyway, but the point still applies. We should be making use of the ISA allowance, which is £20,000, and ideally using every penny of that up before we start then using general investment accounts. Once again, this happened because I wasn't aware of different platforms. I also wasn't aware of different accounts. I didn't know back then what a stocks and shares ISA was. Now I do, which is why I'm trying to obviously spread this message. So those 3 mistakes are sort of linked together. Number 4 then came after this. when I discovered a stocks and shares ISA. Unfortunately, I still hadn't discovered other platforms, so I was still using Halifax Share Dealing. I opened up a stocks and shares ISA with them, and I invested into a very high fee active fund, which was mistake number 4. This was of course before I knew about the beauty and the power of index funds, which really is the lesson to be learned here. Use index funds instead of active funds. Overwhelmingly, data and history shows that index funds beat the large majority of both active funds and individual investors like ourselves. Not to mention index funds are passive, low fee, low stress, low maintenance, very hands off. And of course, we get the average return of the market, which will compound our wealth over the long term. There's a whole list of benefits. I've got a whole video, I'll put it up here somewhere if you want to check it out. But yeah, my 4th mistake here was to essentially put my money into a very high fee active fund. Well, I say very high fee, it was 0.8% I think, which there are actually active funds which are higher fee than that, which can charge you 1 to 3%. So in the grand scheme of things, it wasn't disgustingly high. But when I compare that to the global index fund I invest into now, which is 0.23%, it's literally 75% cheaper. And if you run the numbers on that, by saving myself that 0.57 fee, over the long term, that is going to save me tens of thousands of pounds.
Sometimes my genius it's almost frightening.
So it's really worth trying to reduce those fees as much as possible. To move on lastly now to number 5, it's been a pretty short video, but I wanted to rattle through them, is checking my portfolio on pretty much a daily basis. I feel like this is a very common thing for people to do. You know, you've got it on your phone, you can just go on it, see what it's doing. I would strongly advise against doing this. There's a few reasons why. If you check it daily, you're more likely to get sucked into carry on to check it daily, which is a bad habit to get into. Not to mention, it's really not like healthy mentally, looking at sort of your portfolio fluctuate up and down every second of the day. But worse than that, if you are checking it constantly, you could get drawn into the emotional side of investing and buying and selling based on emotion. And really, the best and simplest strategy is simply just to buy and hold for the long term. If you start getting sucked into buying and selling daily, you're going to be checking it even more, you're going to be incurring fees. So it's obviously much better to almost check it as little as possible. So avoid checking the prices regularly. Honestly, right now, the most I look at my portfolio is probably once a week. It's probably even less than that, maybe once every 2 or 3 weeks, just when I go on to update my MMS investment portfolio tracker. Link in the description if you want to get your own. One place to track all of your investments, and it's the best spreadsheet in the game. But yeah, that wraps up this video, a fairly short one. Hopefully, I guess I'll see when I'll edit it. But 5 mistakes that I made. As you can see, a lot of them were right at the start in my very first investment, buying based on the tip, buying with high commissions, including trading fees and FX fees, and then selling fees, and buying within a general investment account rather than an ISA. Number 4 came shortly after, essentially using an ISA, a stocks and shares ISA. Good move by me, but I invested into an active fund. Luckily, shortly after that, I discovered index funds and started using Vanguard. And mistake number 5, I thought a very, very common one, particularly amongst us younger people who are on our phones a lot, is checking prices daily, which we want to avoid. I hope you found this video useful. If you yourself have made any of these mistakes or any different mistakes, please leave them in the comments and we can of course all learn from each other. Once again, feel free to subscribe down below to not miss any future videos, and I will see you in the next video. Thank you very much for watching.